Welcome to Talk Tickers. Today, we're digging into the latest from automotive supplier Dana Incorporated. And let me tell you, this quarter was an absolute masterclass in how a company's story, its strategy, can totally blow its numbers right out of the water.
Okay, let's just get right to the heart of it because this is the question everyone was asking. I mean, on the surface, the quarter looked like a complete disaster. The headline earnings number, a huge, massive miss. And yet, the market absolutely loved it. So what on earth did investors see that the numbers were hiding?
And when I say miss, I mean it wasn't even close. The Wall Street consensus was looking for adjusted earnings of 39 cents a share. Dana delivered just 5 cents. That's an 88% miss. Ouch. And it wasn't just earnings. Revenue for their main business came in way light too. $1.95 billion versus the expected $2.55 billion. In basically any other scenario, those are the kinds of numbers that would send a stock into a nosedive.
But that is not what happened here. Not at all. The stock didn't just avoid a crash, it rallied. It closed up over 7% on the day. And look at the volume, more than double the day before. The market was basically screaming, we don't care about this quarter's miss, we are buying into the new plan.
So that brings us right to this, Dana's Q2 earnings paradox. You see, the market just completely ignored those backward-looking numbers. Why? Because this wasn't a story about numbers. Nope, this was a story about strategy. And management did an incredible job of getting investors to focus on the future, not the messy past.
And this was the reason why. It all came down to one massive, game-changing number. Dana dropped a bombshell. They announced a deal to sell their entire off-highway business to Allison for a whopping $2.7 billion. Now, this wasn't just some minor housekeeping. This was a fundamental reshaping of the entire company.
This huge sale is really the launchpad for what management is calling the new Dana strategy. Think of it as the single catalyst that unlocks a total transformation of the company's balance sheet. And frankly, its entire reason for being an investment.
So the really critical piece is what they're going to do with all that cash. And they laid out this beautifully simple, super powerful 3-step plan. Step 1, close the sale. Step 2, take that cash and just hammer down their debt. And Step 3, launch a massive $1 billion capital return program directly to shareholders. It's a trifecta. It simplifies the business, it de-risks the balance sheet, and it's built to create a ton of value.
The CEO, Bruce McDonald, couldn't have been clearer on the conference call. He said the whole point is to get the company's net leverage, basically its debt compared to its earnings, down to around 1x. For a cyclical company like this, that is a huge de-risking event. It just gives them so much more financial firepower and flexibility from here on out.
And they are absolutely not wasting any time on that shareholder return piece. In the second quarter alone, they bought back 14.6 million shares. Now they're committing to send $600 million back to shareholders in 2025, and they're planning another $100 to $150 million in buybacks just in the next quarter. Management basically said they think the stock is significantly undervalued, and you know what? They're backing it up with cold, hard cash.
Okay, so that's the big strategic pivot. But for the market to really buy in, they needed to see what's next for the business that's left over. And this is where management really sealed the deal, laying out a super confident and detailed plan for the new, more focused Dana.
And you can see that confidence written all over their guidance. Think about this. Despite that big Q2 miss, they actually raised the full-year outlook for the remaining business. They're now expecting higher sales, higher earnings, and higher free cash flow. They're pointing to things like getting tariff costs back and just running the business better.
A big piece of that confidence comes from just plain good execution. You see, they're so far ahead of schedule on their cost-cutting plan that they've jacked up the total target to $310 million in annual savings by 2026. This isn't just some far-off goal either. They've already locked in $110 million of that this year. They're delivering.
Now, to really get the next part of this story, we've got to quickly talk about a key term: stranded costs. It's pretty simple. When you sell off a huge piece of your company, some of the central corporate costs, like the IT department or legal team that used to serve everybody, get left behind. So getting rid of those stranded costs is absolutely essential to making the new, smaller company more profitable.
And this is the proof. Management didn't just say, trust us. They gave a step-by-step roadmap for how the new company gets to a 10% EBITDA margin by 2026. It's not magic. They broke it down. A full point from cost savings, almost another point from new business they've already won, half a point from wiping out those stranded costs we just talked about, and the rest from just running a tighter ship. It's a super clear, totally credible path.
And if anyone had any lingering doubts about their conviction, the CEO just put them to rest with this quote. He called the 10% margin target a commitment. And then, using a golf analogy, he said he views it as a tap-in. For you non-golfers out there, that's like saying it's a sure thing, an easy putt. That level of confidence is exactly what investors wanted to hear.
So, let's wrap this all up. What does it all mean for the stock from here? Here's our take. This is the next call.
Looking ahead, there are really two big catalysts to keep an eye on for the rest of this year. First, watch for them to execute on that big chunk of share buybacks in the third quarter. That's going to provide a nice floor for the stock. And second, the big one, the official closing of that off-highway sale in late Q4. That's the moment the transformation becomes real and the cash hits the balance sheet.
So for our official rating, we are calling the equity an outperform. The market was absolutely right to look straight past one messy quarter and focus on the birth of the new Dana. This is a much cleaner, simpler story now. It's all about paying down debt, firing up the shareholder return machine, and following a credible path to much better profitability.
Now, for a potential trade idea, we're looking at something like selling cash-secured puts with a strike price below where the stock is trading now. It's a way to express a bullish view, and it lets you pick the exact price you'd be comfortable buying the stock at. You're basically taking advantage of the strong floor that management is building with their own aggressive buyback program.
And as always, just a quick reminder that this explainer is for informational purposes only. This is not financial advice,